All right, let's talk about investing for 2026. If you're thinking about your next moves and where to put your money, you are in the right place. We've combed through the latest expert analysis and boiled it all down to three main strategies, covering everything from high-risk bets to the bedrock of long-term wealth. Let's dive in. So, the big question, right? Where is the growth going to be? It's what every investor is asking themselves as they look ahead. And, after digging through all the research, some really clear patterns and philosophies start to emerge from what the experts are saying. Now, it's not like you have to pick just one of these. In fact, a lot of savvy investors actually use a combination, but they really represent three totally different ways of thinking about the market. We're going to break down each one, picking individual stocks, buying the entire market with index funds, and then targeting specific trends with ETFs. First up, let's talk about what we'll call the high conviction path, picking individual stocks. Now, this strategy, it's definitely not for the faint of heart. This is for the investor who has really done their homework and believes they've found the next big winner, a true game changer. So when you buy a stock, you're not just buying a tiny piece of the market. Nope. You're buying a piece of a specific story, a specific technology, a specific vision. Your fortunes are going to rise and fall directly with the successes and failures of that one single company. And wow, the scale of success here can be absolutely staggering. We are talking about companies like Microsoft and Apple with market values in the trillions of dollars. That's trillion with a T. It's just a powerful reminder of how much value the market can place on a single dominant company when things go right. The analysis from the sources consistently points to these tech titans. And yeah, they're familiar names, but each one represents a pretty unique bet on the future, right? You've got Microsoft's dominance in AI, Apple's incredible ecosystem, NVIDIA's absolute lock on the hardware that powers it all, Amazon's cloud infrastructure, and of course, Tesla leading the charge in the EV transition. So what's the common thread that ties all these companies together? Well, they're all building the infrastructure of the future. The bet isn't just on a single product. It's on the foundational technology that's going to be powering our economy for decades to come. But let's be real, betting on individual stars is risky. For every superstar athlete, there are hundreds that just don't make it. So what if you'd rather just bet on the success of the entire league? Well, that brings us right to our second strategy, diversification. This approach is a whole different ballgame. Instead of trying to find that one diamond in the rough, you're buying a small piece of all the major players at once. The goal here is to capture the return of the overall market, which helps smooth out those dramatic highs and lows you see with individual stocks. And the core appeal really comes down to three pillars. You get instant diversification across a ton of companies. It's incredibly cheap to own, thanks to super low fees. And historically, it's been a very reliable way to build wealth over the long haul. And you'll see a lot of popular options out there. You could buy the 500 biggest U.S. companies with an S&P 500 fund, or go even broader and buy the entire U.S. market. You can also target specific styles, like funds that focus on companies with high growth potential, or others that hone in on established firms that consistently pay out dividends. Just think about that number for a second. 500. With one single purchase of an S&P 500 index fund, you instantly own a slice of 500 of the largest, most influential companies in America. That's powerful, immediate diversification. So you can make a surgical strike with a single stock, or you can capture the whole market with an index fund. But what if you want something in between, a way to be both focused and diversified? Well, that leads us to our third strategy, targeting specific trends with exchange-traded funds, or ETFs. Think of ETFs as a kind of hybrid. They bundle stocks together like an index fund, but they often concentrate on a very specific theme, like robotics, or cybersecurity, or clean energy. And here's the crucial part. You can trade them throughout the day just like an individual stock, which gives you a ton more flexibility. These examples really show you the power of this approach. With QQQ, you can invest in the 100 largest innovators on the NASDAQ. With something like IRBO, you can make a concentrated bet on AI and robotics. Or you could broaden your scope to thousands of smaller companies, or even buy the entire global stock market with one ETF. So what's the simplest way to remember the difference? Here's how I think about it. Traditional index funds are priced once, at the end of the day. They're typically very broad, built for long-term buy and hold investing. ETFs, on the other hand, trade all day long and are often used more tactically to target specific sectors or themes that you believe in. Okay, so we've covered the three distinct paths that the analysis highlights. Now let's just put it all together in a simple framework to help you decide which one might be right for you. It really all comes down to trade-offs, doesn't it? If you want the highest potential for growth and you're okay with the highest risk, individual stocks are the way to go, but they demand high conviction. For simple, set-it-and-forget-it diversification, index funds are a classic. And for targeting specific trends with the flexibility of day trading, well, ETFs are built for exactly that. Ultimately, the expert analysis doesn't point to one single best strategy for everyone. The key takeaway is that the right approach is about matching the strategy to your own goals, your tolerance for risk, and your personal vision for the future. So the real question is, which path is right for you?